In this recording, we're going to look at the taxation of primary producers and the special rules that apply to these. We're going to kick this off by looking through several types of businesses to determine whether or not they fall under the primary producer regime. The first primary producing industry that we're going to look at is wineries. Now, there is a definition of primary production business in the new Tax Act, and in order to fall under this particular regime, you have to be both a primary producer and in a business. Now, there are quite specific subsections within that definition, and one of those that is not going to be sufficient in terms of wine is that, well, it is sufficient to actually be the producer of grapes, but the treatment of grapes, in other words, taking the agricultural produce and then transforming it in some way to make a non-agricultural product, i.e. wine, is not actually sufficient to fall under the primary production regime. In that situation, you're really essentially a manufacturer rather than a producer of primary industry goods. The next one to look at is share farms. Now, this is this idea that you have land that belongs often to someone else, and you do the actual act of doing the grazing yourself, but not necessarily on your land and not necessarily with your animals. But as it happens, the way that this regime is structured, that neither of those things are actually strict requirements. In fact, in many ways, it's the people who are performing these primary production activities that are more likely to be classified as primary producers as opposed to the mere passive owners of such things. So in this situation, what we would call a share farmer will be deemed a primary producer. So the next thing to look at is whether people who have a non-primary production sort of primary job or profession, can they be in the business of primary productions and thus fall under the preferable tax treatment afforded by that? And the answer is, well, it really depends. Yes, a person can be deemed to be in the business of primary production and still have, I guess, a day job. And when trying to determine whether or not a person falls within this idea of being in business, we actually refer back to some of the earlier sort of court cases where we looked at this. So Evans, for example, is the case involving a gambler. There the commissioner tried to argue that that particular taxpayer was in the business of gambling and therefore the receipts ought to be taxable. One thing that sort of flowed down from Evans is this advancement of this test of determining whether a person is in a business or not. And really, there are many factors, none of which are strictly determinative. The idea is that the courts will look at multiple factors, such as whether or not there is commercialization, whether or not there is systematic record keeping, whether or not there is an ABN number, whether or not the particular person devotes a large amount of time towards it, whether or not they participate in industry sort of functions or education, whether or not they, I guess most importantly, are really viewing this as a business and unto itself, in other words, for the making of profit. Whereas the actual making of a profit, at least initially, isn't quite so as important as the taxpayer's intent. So with that definition that's been developed by the courts, we have to also note that this common law definition is somewhat modified by the legislation itself. So the definition for business in the Tax Act specifically excludes, so they specifically note that it excludes the occupation of a person as an employee. But it also does widen it in another aspect to also include things that a person does within the scope of trade, a profession, employment, vocation or calling. And so when determining whether this medical practitioner is leasing cattle for breeding, we would look at each of these factors. Has this person really set this thing up to be a business? Is there this intent to have a long-standing system in place to make a profit? Does it have this commercial aspect? And whether or not there are commercial or business-related records. Does the person have an ABN? All of these things are taken into account. And really, if the taxpayer does have those, then yes, they can fall under the primary producer regime and receive the favourable tax treatment as a result. Now, primary production can, of course, include people that do fishing. And the important thing to note here is that the lessee of a fishing boat who takes the boat out and catches fish, they are, at least far more probably, to be in the primary production sphere, and that they're the ones actually conducting the operations. The flip side of that, the owner of the boat, particularly if there's no real connection or nexus towards the activity itself other than obtaining a fixed amount of money through a lease, is not likely to be a primary production business. And so that's a really important concept. The benefits that come from this primary production favourable tax treatment flow from the person doing the particular activity, not so much those that are financing or supporting it. Now, the next thing to look at is the transportation of logs to a mill. Now, there is, for better or for worse, a slightly prescribed or possibly over-prescribed description in the Act in 995-1, and then under the definition of primary production business in subsection H. And basically, you can be and fall under this regime if you do transport trees, provided you are actually the ones who are cutting the things. So if your particular business involves just the hauling of trees that other people have cut, then you're not going to fall within this regime. Whereas if you are substantially involved with the cutting of those things, then you can be. You're probably aware at this point that the shareholders of a company are quite distinct and different in the eyes of the law from both the board of directors and the company itself as a distinct entity. And that flows from the Salomon and Salomon, that famous case in company law. And so the shareholders of companies that are operating primary production are not going to fall under the PPB regime. They don't have that particular connection. It's the company itself that receives the favourable tax treatment. However, the beneficiaries of trusts can fall under the favourable regime, and that's through virtue of the Act in section 392-20. There it states that for discretionary trusts where a particular beneficiary is receiving income that is derived from primary production, then that income that's allocated to that person will fall under this regime. And certainly with fixed trust as well, again, if that income that would be allocated to a particular taxpayer in the year is going to enable that particular beneficiary to again receive the favourable treatment under this primary production regime. And so here, in this example, if you've got a beneficiary and they are presently entitled to income, they will be deemed to be primary or within the scope of a primary production. In this part of the recording, we're going to be looking at the averaging system. This is where a taxpayer who is a primary production business is able to gain tax offsets that are calculated in such a way so as to smooth their income across several periods. We're going to be looking at this across 7 years, and then after examining the average income for each of those periods, we're then going to incorporate some non-primary production income amounts and just see how that impacts and affects the calculations. So in the first tax year here, and this may seem quite self-explanatory, we can't use the averaging system, and that's because there aren't multiple years in which you're averaging the things over. A taxpayer has to be in primary production for at least 2 or more years in a row before the averaging rules can actually apply. Now, in the second tax year, we also can't use averaging, and that's because where we had our first tax period in tax year 1, our income's actually gone down, and so you can't use the averaging system here because your actual basic income's gone down in that period. So as a result, there's no need for any form of tax relief. So in tax year 3, our income's just popped back up again. And in this situation, the taxpayer can use the averaging methods. Now, it's important to note here that while the taxpayer can average across up to 4 previous years, we will not be averaging back through to tax year 1. We'll only go to tax year 2, the point at which the division for averaging actually begins and can apply to this particular taxpayer. And so the average income is quite a simple calculation. We just take each of the years from where averaging starts and just divide them by the number of years in that that we've included in the calculation. And also note that the taxpayer can average the current year plus backwards up to 4, so you can have basically 5 years worth in the calculations. Also note that basic taxable income excludes a few statutory items that would otherwise have been included in your income. Employer termination payments, certain capital gains, and some superannuation contributions and deductions from those are excluded from this basic taxable income definition. And so here the average income we've got is simply taking tax year 2, which is $9,900, add that to the $11,100 in the second year, and just find the average, which is $10,500. And again, in tax years 4, 5, and 6, we are averaging, but again, we're only going back to tax year 2. So for the calculation tax year 4, we're going to have 3 years that we're going to do, tax year 2, 3, and 4. For tax year 5, we're going to be doing it across 4 years. Again, 2, 3, 4, and 5. And for tax year 6, we're going to do the maximum, which is over 5 years, 4 years plus the present one. In tax year 7, as we can only go back 4 years before the current year, the first one of $9,900 essentially falls off. We're just going to be putting 5 items into that calculation. So the next thing to try and look at is, well, now that we've calculated what the average income is for a particular taxpayer at a particular time, how do we actually determine what their tax payable is? Now, this is made a little bit more complex where a taxpayer has both primary production and non-primary production income, and these are combined using the rules in Division 392. And so there's really either a 5 or, one could argue, a 6-step process to calculate the amount of tax payable. And we start by finding the basic taxable income for the current year. And it's important to note that this basic taxable income again excludes certain unusual transactions, for example, employee termination payments, capital gains, and certain superannuation contributions. Then we take the average income calculation we've got and we work out something called the comparison rate of tax. And basically, that's the amount of tax that we would have paid if this was our income in this particular year using the average income. We work out a percentage of that, and then we take that particular percentage that we've worked out as this comparison rate, and then we're going to use that later on by comparing that percentage with the amount that we're actually going to be paying, or we would otherwise be paying on our basic taxable income. So in step 3, we calculate the averaging component, and this takes into account the idea that, look, if you've got a lot of non-primary production income, that is going to it's going to reduce the amount of offset that you're going to get at the end, with the shade out point being at $10,000. Then at step 4, we basically we just compare these two rates of tax. The one that you would be getting if you were using the comparison rate, in other words, where we'd calculated the percentage using our average income, and then we compare that amount of tax payable with what we would just normally get on the tax on the tax scales. And this comparison between the two, the difference is called the gross averaging amount, and that's multiplied back in step 5 in order for us to actually get this averaging adjustment, which is the amount of the tax offset. And the final step, which isn't actually on the chart here, is once you've armed with this particular amount for your tax offset, is that you would just calculate your taxable income for the particular period, and the offset amount is just simply used to reduce the amount of tax payable, in a similar way that a rebate or an offset or a franking credit would for other taxpayers. So to calculate the amount of offset and eventually the amount of tax payable by this taxpayer, we start with their taxable income. And again, there's no evidence of any CGT or ETP payments. So the basic taxable income is simply going to be the $25,600 of primary production income plus the $10,000 non-primary production income. That's just simply added together to get the basic taxable income. Now, the average income came from an earlier step where we went back over the previous 5 years after averaging had been started for this particular taxpayer, and simply divided that by 5 to get $18,740. And so to find this comparison rate, we simply use the tax scales to determine, well, if this person was paying tax on this average tax rate that we've got, not saying that they are, but if they were, then that amount is going to be, based on the tax scales, is only just above the tax-free threshold, and so the amount payable is only going to be $102.60. And so the comparison rate of tax, the percentage, is basically taking the amount of tax payable and dividing that by the amount of this average income that we've already calculated. So the percentage here for the comparison rate of tax is very, very, very small, 0.55. So just under, or just over 0.5% for the comparison rate. Now, this averaging component in the next step, where the non-primary production income is at or above $10,000, we don't take it into account. So the averaging component we're going to use is just going to be the primary production income that we have. So the next step is to just calculate what the amount of tax this taxpayer would ordinarily be paying. So here a taxpayer has an income of $35,600, and that again, the first $18,200 is tax-free, and then it's at 19 cents for every dollar earned beyond $18,200. And so the net result here is the taxpayer is going to be liable for, would have been liable for $3,306. And so we're going to compare that with what this taxpayer would have had if would have paid tax if this percentage from or this comparison rate was used instead against their entire income. So if we take this very, very small comparison rate of 0.55% and multiply that with, again, their basic taxable income of $35,600, we get, again, quite a small amount, $195.80. And we're comparing that with the amount of tax payable that we would otherwise have on the regular tax scales, which we've just calculated to be $3,306. So the difference between those is $3,110.20. Now, the averaging adjustment, which is essentially the calculation for the tax offset that this taxpayer will receive, is taking this gross averaging amount that we've calculated, multiplying it by the averaging component, and dividing it by the base taxable income. So here it's $3,110.20 multiplied by the $25,600, as we didn't have any, our non-primary production income was equal to or greater than $10,000. And we divide that by their basic taxable income, which we calculate above to just simply be $35,600. And so the amount that this comes out from the formula is simply going to be the tax offset. And all we do to calculate the actual amount of tax payable, given that we've worked out earlier the tax payable at the current rate of $3,306, we just take the tax offset away from that to find the amount of tax that's going to be payable by this taxpayer. So here it's $3,306 minus $2,236.55 to get $1,069. And tax payable figures are always rounded down to the nearest dollar. So the final thing we're looking at is calculating the tax payable where a primary producer who's using the averaging methodology also has less than $10,000 of non-primary production income. And so we start again with this calculation of the basic taxable income. Here it's simply going to be $3,000 less than the previous example, and so now it's $32,600. And the average income is going to be, again, it'll be 3,000 divided by 5 smaller. So here that'll calculate out to being $18,140. And as you may note, that falls under the tax-free threshold. So that the tax payable and the comparison rate of tax are both going to be 0. So the next thing we need to note is to calculate this thing called the averaging component. Now here, where we have non-primary production income of less than $10,000, they have what we call this the shade out amount. So basically, we take the taxable primary production income and we add to that $10,000 less the amount of non-PPI that we have here. So basically, because we've got $7,000, we're going to get $3,000 being added to our averaging component, to the net result being $28,600. And again, we go through and calculate based on our taxable income, our basic taxable income, what the amount of tax we would ordinarily have. Here that's $2,736. We then work out what this is using the comparison rate, which, because the comparison rate is 0, is going to be 0. So that $2,736 is also what we use for our gross averaging amount. And so once we've got each of these 3 pieces of information, the gross averaging amount, the averaging component, and the basic taxable income, we put these into a formula, multiply the gross average amount with the averaging component, then divide by the basic taxable income to get the final tax offset figure. In this situation, it's $2,400.29. And again, we go through to calculate the amount of actual tax payable is the tax that we would pay on our basic taxable income using the tax scales, less this offset. Here, the tax on our basic taxable income is $2,736. Take away the $2,400.29 to get the final figure of $335, which had some decimal points, and these are rounded down to determine what your tax is payable in any given tax year.